The Straits Times Index had just hit an all-time high, and depending on who you ask, this could be either Singapore's decade finally starting or a bank bubble that's about to burst. To find out who's right, in this video, I'll be going through all 30 companies in this index to show you where the gain really came from, what Singapore's own history says about buying at record high, and most importantly, is it too late to put in your money now? So let's not waste any time and let's jump right in. The Straits Times Index or STI is the 30 largest and most liquid companies listed on the Singapore Exchange. So you have companies like DBS, OCBC and Singtel. For most of the last 2 decades, while everything else was going up, like your HDB price, your coffee paying price, and your chicken rice price, STI, or what some people like to call the super terrible index, was basically flat for years. After the STI peak in October 2007, the great financial crisis happened and STI crashed by 62.4%. And even though it did recover from that low, it just sat there and did nothing all the way until March 2024. Throughout that 17 years, STI returned basically 0%. And even if you include dividends, you only make around 2 to 3% a year, making STI even worse than char siu, because at least you can still eat char siu. Speaking of holding Singapore stocks for a long time, if you were one of those who bought some Singapore stocks years ago and just left them sitting inside your CTP accounts, you can actually move them over to moomoo SG now. Moomoo offers low trading fees for the Singapore markets at just 0.03% commission and a 0.03% platform fee, with a minimum of 99 cents each. If you are new to Moomoo, you can enjoy first year free commission for Singapore stocks. Moomoo lets you see everything in one place: the company's financials, its valuation, and what the analysts are saying. You can also claim the free level 2 data for Singapore stocks in the app, which shows you 40 levels of live bid and ask. Managing dividends on Singapore stocks is easier on Moomoo too. You can use the dividend calendar to track payout dates and browse the dividend ranking if you are looking for ideas. And if you have turned on Smart Save, dividends are automatically invested into Moomoo Cash Plus, so either cash can earn more interest. Moomoo Singapore is running a transfer-in promo right now, where you can get up to $3,500 worth of trading cash coupons, or even an iPhone 17 Pro Max when you transfer your stocks in from CTP. On top of that, if you transfer at least $10,000, you will also get an $88 trading cash coupon, a 1-year Singapore stock 0 commission card, and a lucky draw chance to win prizes worth up to $2,000. Terms and conditions apply. If you are new to Moomoo Singapore, you also get the welcome reward of up to 1.2k when you sign up with my link and meet the terms and conditions, which includes $100 worth of NVIDIA shares exclusively for my channel, on top of 0 commission for the US, Hong Kong and Singapore stock trading. Simply follow the steps here and key in my promo code to get your exclusive reward. For more details, refer to the link promotion page in the description below. Then finally in March 2024, the STI started to awaken. Over the next 29 months, it shot up by 85%, all the way to a new record high. Green Merlion, let's go! During this period, STI outperformed not just the S&P 500, but also QQQ and almost every market in Asia, except for South Korea and Taiwan of course. Both of those markets a bit key sell one. So then, what's happened? Let's start with the bank first, because they have been whatting big recently. So back when interest rates were high, our banks were making a ton of money on loans, to the point that they had more capital than they knew what to do, and they started handing the money back to investors. DBS added a 15-cent capital return dividend every quarter. UOB paid out a 50-cent special dividend, and OCBC did a 16-cent special dividend as part of a $2.5 billion capital return, its first special payouts since 2005. Then from 2024, rates started coming down, and plenty of people expected bank stocks to fall with them. However, the opposite happened. Instead of falling, the bank stocks kept on climbing, and that's because the market realized that these banks are no longer a pure bet on interest rates. Today, the money comes from wealth management fees, insurance, and trade flowing through ASEAN. For example, DBS alone grew its wealth income from $4.43 billion in 2023 to $5.7 billion in 2025. That's a 29% jump in 2 years, and DBS expects it to keep growing. Besides the banks, the Singapore economy was growing well too. Earlier this month, our Ministry of Trade and Industry raised its 2026 growth forecast for Singapore to between 4.5% and 5.5%, up from 2% to 4%. And even that might be too low, because Singapore grew 6.1% in the first half, which is above the top end of the new range. At the same time, loans were growing at 8.7% a year, while deposits are only growing at 6.8%. This is good news for the banks because this means that more of their money is out there earning interest instead of sitting around doing nothing, like a lazy bum. On top of that, the government has been working hard to revitalize our stock market. So MAS has set up this $6.5 billion equity markets development program. With it, MAS aims to improve market liquidity, encourage more listings, and attract greater institutional participation. And retail money has been pouring into. In the financial year that ended in June, Singaporeans put a net $2.4 billion into the market, and daily retail trading value was up 52% from the year before. This is the highest it has ever been in 12 years. So when you add up everything, real earnings, a real economy, and money arriving from every direction at once, you get an STI that's at an all-time high. That said, even though the STI is at a record high, if you look a little closer, you'll find that 13 of the 30 companies in the STI are down this year. So how does nearly half of an index fall while the index goes up? That's the weighting doing its work, where the bigger the holding weightage, the more impact that it will have on the index. Check this out. DBS alone takes up 29% of the entire index, OCBC is another 18.9%, and UOB is at 9.3%. That means that those 3 banks by themselves make up 57.2% of the entire STI. And together, the top 10 companies are 81.3% of the index, which leaves the other 20 companies splitting the remaining 18.7% between them. This means that whenever the banks have a good year, the index will have a good year, no matter what the other 20 are doing. And that's exactly what's happening right now. So far in 2026, the STI has gone up by 24.2%. And when we break down where this year's gain came from, you can see that those 3 banks alone produced 20.6 points of it. And if we add SGX in, that will be 22.2 points. All in all, the 10 biggest contributors produced 25.3 points, while the other 20 companies dragged it back down by 1.2 points. But then something still doesn't add up here. If our economy is doing that well, and if MAS is pouring billions of dollars into the markets under that program, then surely more companies should be going up, right? So here's what's actually happening. According to Maybank, out of the $6.5 billion money from the MAS program, only $3.95 billion has been allocated, and evidence of material deployments is not yet visible. Not only that, over that same stretch, SGS also saw $2.9 billion of institutional money flow out. Instead, a big part of that rally has to do with banks, or more specifically, bank earnings. Just last year, the 3 banks alone made $23 billion worth of total profits. And if we add up every other company in the index, all 27 of them, you get about the same amount, which means 3 out of the 30 companies earn about half of all the profits in this index. And prior to that, the banks were earning even more. Or in other words, this rally is mostly a bet on banks. Once you understand that, the question then changes from is the STI expensive to are DBS, OCBC and UOB still a good value? Now, the usual way to check if a bank is expensive or not is to look at its price to book value, aka how much are you paying for every dollar of the bank's own money? When compared to the last 18 years, DBS price to book is now sitting at the 100th percentile of its own range, and so is OCBC, which means that neither of them has ever been as expensive as they are right now. Meanwhile, even though UOB price to book isn't at the 100% yet, it is still expensive nevertheless. But before you be like, banks are expensive, they are going to crash, good luck and take care. There's a catch here. Since so much of the bank's income are now coming from fees instead of lending, price to book has become a weaker way to value them. That's because the price to book ratio only looks at the book value, and that book is now doing less of the earning than it used to. According to Aswaf Damodaran, the Dean of Valuation, a much better way to value a modern bank is by looking at its earnings power, or its return on equity. So if you plot each bank's price to book against its return on equity, you will get this. All 3 banks are now trading at around 32 to 42% premium to what their returns justify. In fact, because of how strong the 3 banks have been rallying this year, that premium has widened a lot. In just 8 months, all 3 have gone from roughly fair value at the start of the year to where they are today. Now, of course, even though the banks take up a large part of the index is still made up of a lot more names. So let's compare the price of the entire Singapore market against its historical earnings per share. Over the last 10 years, STI earnings per share have gone up by 26%. Meanwhile, the STI is up 94%. This tells us that only about a third of the gain came from the companies actually earning more, while the rest came from investors willing to pay more for the same dollar of earnings. Or in other words, investors are just a lot more optimistic about the STI today than they were 10 years ago. So what do the analysts think about this? Interestingly, most of them are already behind. For example, Maybank's 2026 target is 5,500 points, DBS is 5,250 points, UOB Kay Hian's is 5,000 points. Meanwhile, the STI is already at 5,768 points. The one house that still thinks that the STI can go further is JP Morgan, with a base case of 6,000 points and a bull case which they raised to 7,000 just last week. And back in October 2025, DBS even made a bold claim saying that the STI could reach close to 10,000 points by 2040. In order for this to come true, STI would need to give close to 7% return a year, including dividends over the next 14 years. DBS rationale is that the STI goes back to the kind of valuation it used to get in the 2010s, with earnings growing steadily from here. However, with that being said, it's best to take these price targets with a huge pinch of salt, because analysts get them wrong all the time. One good example was Citi, which cut all three banks to a sell back in August 2025. If you had listened to them, you would have missed OCBC nearly doubling from there and DBS going up by another 50%. But then, is it actually too late to buy into the STI now? Obviously, I don't have a crystal ball, so I don't know. But here's what history tells us about buying at record highs. Take the S&P 500. If you had bought it at an all-time high, you would have done better than if you had bought it on any other random day. This is true whether you are looking at 1 year horizon, 2 years, 3 years, or even 5 years. But that was the S&P 500. So how would this look like on the STI? When I ran that same analysis on the Straits Times Index, I found that investing on the record day did better over 3 months, 6 months, and 1 year, as compared to investing on any other day. However, once you go beyond a year, buying at the record did worse instead. And that's because Singapore doesn't hit record highs often. So at those longer horizons, one bad episode is enough to drag the whole thing down. Check this out. Here, you can see the 5 times since 1987 that the STI hit a new record after going at least a year without one. 1993 was a great one, where the index just kept climbing after the record. Meanwhile, the 1996 one ran into the Asian financial crisis and the index crashed. Same for 2000, which ran into the dot-com bust. Then in 2006, the STI gained 27% in the first year before the global financial crisis happened and crashed the index by 62.4%. The fifth one is the one that we are living in right now. What this tells us is that market crashes don't happen just because they are at all-time highs. Instead, they often happen due to a market shock. And there is one more catch with using STI history as a guide. The index back then isn't really the same index that you are buying today. So back in 2002, the top spot in STI wasn't DBS, it was actually UOB at 17%. And sitting right up there with the banks were Singapore Press Holdings and SIA, both at around 7%. Then by 2010, the biggest name in the index was actually Singtel, while the three banks only add up to just 26% of the index. Today, DBS on its own is already 29%. Heck, even the banks themselves has changed. Back then, they mostly made money by lending it out. But as we saw earlier, a big chunk of their profits now comes from wealth management and fees instead. So then, what do you actually do? First up, if you are feeling FOMO just because the STI has already gone up by 24%, just know that investing based on emotions is the worst way to invest. If you want in, it's always best to stick to a well-proven strategy such as dollar cost averaging in rather than FOMO in. Second, don't over-concentrate either. A big part of the STI today is made up of the three big banks, so any bad news that hits them will drag the entire index down with them. Not just that, when you compare the Singapore markets against the rest of the world, you'll find that Singapore is actually less than 0.5% of the world's stock market. What this means is that Singapore is just a tiny market, and you shouldn't place all your bets in it. And remember, you are already invested in Singapore's future just by being here. our jobs, our homes, our CPF are all in Singapore. So buying even more of the STI is really just doubling down on the bets that you have already made. That's why it's still worth owning the rest of the world too, so that you get the sectors we simply don't have here, like healthcare, big tech, and semiconductors. But don't get me wrong, none of this means that you should skip the Singapore markets. If what you want is a market that pays you while you wait, the STI is one of the easier ones to hold. It gives you around 3% in dividends today, and as a Singaporean, you get to keep every cent of that because Singapore doesn't tax dividends, while the same dividend from a US stock or ETF would have 30% taken off before it even reaches you. So if you want the stable, boring parts of your portfolio to sit close to home, the STI does that job well. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.